Good afternoon and welcome to MasterChartsTrading.com market recap for the week ending Friday, January 2nd, 2015. Happy New Year, everybody. In this recap, we'll talk about stocks that are correcting after hitting all-time highs. And I think stocks are sort of entitled to a little bit of resting period. But still, this is a uptrend in stock market, so likely this uptrend will resume. Also, bullish divergence is still present in New York Stock Exchange Composite Index, and I'll explain what I mean. Bonds are hitting all-time highs. In fact, TLT have hit an all-time high, and they're still in an uptrend. And we will delve in sort of more deeply into gold and gold miners especially, and see if they're ready for a rebound, or at the very least, have they stopped falling. And also we'll talk about some oil prices, and so far I see no bottom in oil prices yet. Alright, so this is S&P 500 large cap index, SPX ticker symbol, and I highlighted this chart in the past many times. So S&P 500 is bullish and in a long-term uptrend since at least 2011, and some might argue since 2009. Within the uptrend, many buying opportunities were present. Some of the latest ones here in April of 2014, here in August, and then October, and finally, right here on the 18th of December of last year, we entered the market around here, and it seems to be doing well. In fact, it hit all-time high. But right now, over the past 2 to 3 days, I believe, trading sessions, the market has sort of started to correct. Right now, I still don't see any exit signs necessary for me to close this upswing position. Like for example, here, right there, the upswing began, and then price momentum oscillator rolled over right here, and then eventually I closed the position on the December 12th. So far, the latest iteration of this upswing, I don't see price momentum oscillator rolling over just yet right there. So I don't see, I mean, there is a little bit of a selling pressure, but it's not terribly significant yet. So I'll wait and see, and I'll let this position, breathe a little bit and see if the market will right itself and continue higher. So let's look at market breadth, and specifically at New York Stock Exchange Composite Index, which is basically all of the stocks on New York Composite weighted by market cap. And this is about since April of last year. So you can see that New York Stock Exchange Composite is making lower highs. So it's making lower highs, while the New York Stock Exchange advanced decline line and New York Stock Exchange advanced decline volume line are in fact doing the opposite. They're hitting higher highs. You can see here, here, here. So what this is telling me is that the underlying strength is present within the New York Stock Exchange, and likely the price will in fact go higher. At what point, I'm not sure, and it's really difficult to predict, but there is underlying strength both in the number of stocks that are pushing higher, and in the number of large cap stocks that are pushing higher, because New York Stock Exchange volume line is more heavily capitalization weighted. So far I see bullish divergence in New York Stock Exchange Composite. So let's look at bonds. AGG, Barclay Aggregate Bond Fund, and once again, also same thing. It's an uptrend. So there were quite a bit of buying opportunities in AGG. It's a little bit more volatile than TLT because there are more moving parts, because aggregate bond fund is not just treasuries, it's other bonds as well, like agency and mortgage-based security bonds as well. Nevertheless, our latest buy signal was on December 30th of last year, and so since then I believe it hit an all-time high. At the very least, the treasuries hit all-time highs. There is some concern in the community about bonds coming under selling pressure if the Fed decides to raise short-term interest rates. And that's entirely possible. Most likely bonds will come under some selling pressure, but that will be evident once some kind of once the price actually rolls over to the downside. For now, I don't see any signs of bearishness in this chart. This is a bullish chart, and to me, buying dips in a bullish, on a bullish chart makes more sense than selling rallies, because selling rallies is just not as profitable in an uptrend. Okay, now let's look at gold miners, and this is gold miners index GDM, going back to 93, 94 actually, 95, 93, 94 right here, and this is a weekly chart, and this kind of shows bigger trends within the gold market and by extension the gold miners market. So latest signal was in November of 2011 when a bearish signal occurred to us. This is a bearish signal. And you can see that also the momentum rolled over even earlier than 2011 November. But, momentum can roll over, but the price can still continue higher. So it's not entirely, possible to predict the very top at the very bottom. But once the market does turn within a downtrend, for example, there were several very good selling opportunities or shorting opportunities to short the gold miners. So let me show it to you an hourly chart, which is more for some more granularity, so to speak. So I've showed this chart in the past again, and there were several selling opportunities last year. Two of them were actually very good, in March of last year, and another one in September. So September selling opportunity resulted in a very nice, almost 30% loss. Well, loss for the GDX, but gain if you're shorting. So this was a short opportunity. Then in November of last year, there was a counter trend rebound, which immediately failed just a few days later. And once again, I entered the market short right there around November, beginning of December. And since then, really, gold miners have been sort of indecisive, going up and down, up and down. I highlighted this several times in the past. The gold miners were not able to break down they were not able to break down significantly, but they were also not able to rally significantly. So we're just kind of moving sideways in this area between $20 and maybe $17. And Friday was an interesting event. So let me show it to you on a daily candlestick chart. Okay, so this is GDX Market Vector Gold Miners ETF, and you can see it was in a downtrend. There are several bearish patterns here at work. For example, you can see that this is a sort of a triangle consolidation within a bigger uptrend. You can draw a triangle more than one way. But this is just one of the ways to draw a triangle. But an interesting thing happened this Friday. So this is in red right here is a 50-day moving average, and 50-day moving average is important for many investors. People usually buy or sell based whether or not this price closed above it or below it. And I think on Friday there was a conclusive close above the 50-day moving average. So this is definitely a bullish sign, at the very least in the short term. Another thing, if you're a gold bull, so if you're a gold bull, then you can see a lower low, a low, then a higher low, another higher low. So likely the price will eventually roll over. I don't know from which level. If it breaks out above 20, then this high and the next high would be like a higher high. However, if it rolls over and goes down again, that would be this higher low would be negated. But let me show you a little bit of market breadth indicators. So this is gold miners and advanced decline percent line. So this is a number of advances within the index less the number of declines and divided by the number of total issues within the index. So it just tells you how many stocks within a particular index, in this case GDX, are going up or down on each particular day. So this is advanced decline percent line, how many stocks within the index are advancing and declining. So right there on 16th of December, it made a lower low, while the GDX itself made a higher low. So this is called a bearish divergence. In other words, more stocks are pushing lower while the index is pushing a little bit higher. And most likely the reason for that is because of the gold miners advanced decline volume line. So the bigger the volume of a particular stock, and usually large caps within this particular index or ETF will dominate. So the advanced decline volume line made a higher low, while advanced decline percent line made a lower low. So this is bullish. So volume is pushing higher while the number of stocks are pushing lower. And right, so but the rest of the market, and also the bullish percent index, actually started to rise a little bit. So it was at 0 here. So 0 of stocks were on a bullish on a what do they call it, my God, I'm blanking out. PNF on the point and figure chart were making a buy signal. So here at least 6% of the entire ETF are on the point and figure chart buy signal. So that's a little bit bullish, a little bit positive. But from a bearish point perspective, which I am still bearish, there is just more bearish evidence, so to speak. Bigger downtrend from the daily chart and from the weekly chart. This bearish triangle is a bearish continuation pattern. So a breakdown here would argue for even lower prices. Bearish divergence in the gold miners advanced decline percent line, and 0% new highs, new lows still. So like right here, for example, it was at least positive, but here it's still negative. It's still at 0, and it was obviously very negative here. So I am somewhat bearish still, but I'll be proven wrong. If this particular swing that I just highlighted, let me see where it was. This particular swing that started in November 28th and a downswing, if the price closes above around $20, or if it breaks out above this continuation triangle, like maybe at around $19, $20 right there, then I'll call this downswing failed. But at this point in time, I'm letting it breathe, and we'll see, if it rolls over to the downside or if it doesn't roll over. And finally, let's look at oil prices. And I highlighted this chart again in the past. So no bottom in oil. I see no bottom in oil yet. You can see the rune is red above a rune green, and it has been so since July of this year, of 2014. It's just been in a very strong, continuous downtrend. And you can see the same thing, light crude oil candlestick chart. I highlighted this chart last week. So it was a steep drop in price from December 2nd, a consolidation, and then a breakdown from a consolidation on the 29th of December. And also this Friday, the price actually closed below this low right there. So it's at 52, 52.03, no, 52.81. So it actually closed below this low. So unless this, just pops right back up, and I honestly don't see a reason why, because there's a glut of oil in the world, lots of production in Russia and in Saudi Arabia everywhere. They're hitting all-time highs and post-Soviet Union all-time high. So I don't see a reason for oil to just rally all of a sudden. Anything can happen, of course. Some kind of a shock to the system will happen and oil might rally, but I don't see it happening just yet, and we might see prices in the possibly lower 40s even, and maybe in the upper 30s, depending if this plays out, how this plays out. All right, and with that, I wanted to ask you to connect with us. It's very important for us to have you follow us on the mailing list. You can sign up at MasterChartsTrading.com, Twitter, Facebook, or StockTweets. We have accounts there as well, so you can look us up there. Send us a direct email if you have any questions. And all of these charts are located at StockCharts.com, and then this mail address. And let me just show you how to quickly get to the public charts, because most or even all of the charts that I highlighted are located there. So if you go to StockCharts.com website, so if you go to home, StockCharts.com, and then hit blogs, and then scroll down, hit view all public charts, and then scroll down to our chart list, which is Master Charts Trading, an alternative view of stocks, bonds, gold, and commodities. That's it for now. Thank you for listening, and have another great trading week. Goodbye.